Hey there neighbors, it's Nicole Fetter, your local Arizona realtor. With the interest rates being so much higher than we've become accustomed to these last few years, I have a lot of clients looking into second mortgages, equity loans, and HELOCs, or home equity lines of credit. I have some clients that think they're the same thing and other clients that want to know the difference or which one is best for them. So today, we're going to go ahead and look into both so we can compare and contrast the two. Both equity loans and home equity lines of credit are second mortgages, meaning they are backed by your home. Anyone that has equity in their house could qualify for these mortgages. Let's go ahead and jump right in with equity loans. A home equity loan is a loan that is in one lump sum at a fixed interest rate. You are required to start paying this back after you take the lump sum payment out. They are commonly used for a kid's college tuition, making repairs or upgrades to a home. HELOCs, or home equity lines of credit, are a little more complicated than an equity loan. They are a line of credit that's more similar to a credit card than an equity loan. The difference being that a HELOC is backed by your house. It's a second mortgage. You take out a term loan that has a draw period. Usually the draw period is about 10 years. So you can use this loan at will. You can use it once all the way up, pay it off, and use it again. During the 10-year draw period, it usually has a term of 30 years, meaning you can use the loan for 10 years, but you will be paying it back for the full term of 30 years. You are only required to make interest-only payments during the draw period. If you were to only pay those interest-only payments, you would never pay back the loan in full. After the draw period is over, you will have principal and interest payments for the remaining term of the loan to get it paid off, and you will no longer be able to draw from that loan. To review, the differences between an equity loan and a HELOC, home equity line of credit, is an equity loan is one lump sum borrowed at a fixed interest rate. A HELOC is a line of credit that is borrowed having a draw period with an adjustable rate. You only have to pay interest-only payments until the draw period is over, at which time you will be required to pay principal and interest payments for the remaining term. Let's take a look at which loan may be best for you. If you know you need a lump sum of money for construction, upgrades, or college tuition, then an equity loan at a fixed interest rate is probably best for you. If you don't know how much money you are going to need or when you will need it, a home equity line of credit may be best for you. With an equity line, you are only required to pay interest when you are using the money and for the amount you are borrowing off that line of credit. It can be a little riskier as you are only required to pay interest-only payments and you do not have to start paying back the principal till after the draw period is over. But if you don't know how much, it is always nice to only pay interest on the amount that you need to borrow. If you have any questions regarding these loans or anything else, I am always here to help with your home buying and selling needs. Text, email, direct message me with any questions. Thank you for taking the time to watch this video. Please like and share it with your friends and family. Help continue to educate them on the home buying and selling process. And remember,
go better with Fetter. You'll love her forever. She'll get you a home too.